Hey everybody, welcome to Note Night in America. As always, glad to have you guys here on Monday night with us here. We got a great topic tonight that I think many of you guys are going to want to take a lot of notes, make a lot, probably have to ask a lot of questions, but make some notes definitely, because as we all grow in real estate, grow in business, we all want to take our things to a next level. And sometimes going to the next level takes away a lot of headaches, makes it a lot easier for you in the long run of doing business. So we are jacked up for our special guest. But before I introduce him, just a little bit of housekeeping. For those that are joining us for the first time, we do these webinars every Monday night for the most part, provided we're not traveling or out of the country. They are recorded. We've got a variety of people on here, note and real estate investors, people interested in notes, people interested in raising capital. We have hit the record button, so they are shared and live streamed also to YouTube and Facebook. You can always catch the replays too at WeCloseNotes.tv or check out the Note Night in America podcast that we have as well out there too. So make sure you subscribe on our YouTube channel or to the podcast out there. But there's no questions. We're going to make sure that you guys feel free to ask questions throughout. We'll probably, I'll be here to moderate them, but we're honored to have a guy who is doing amazing things, over a 30-year track record of really kicking ass and taking names when it comes to raising capital and really helping other investors create their own syndications and hedge funds out there. And so we're honored to have the chief bottle washer from Bullseye Capital out in LA, a very, very, very avid LA Dodgers fan who is a big fan, but just a wealth of experience. If you've been to Note Camp in the past, we've had him on there before. Just absolutely honored to have the man, the myth, the legend, Mr. Joel Block, join us here tonight, man. How's it going tonight, Joel?
Well, I don't know if I can live up to the man, the myth, or the legend. I don't know. We'll see, but I'll do my best. How about that?
Hey, that'll work, man. That'll work. We appreciate being here and then taking the time to share your knowledge with everybody out here tonight. Because let's face it, I think there's always deals to be had. And I had this conversation before, but a lot of us grow from doing a couple of deals here or there, and then growing to different levels. And as you'll share tonight, I think doing it bigger often takes away a lot of the headaches, and then you actually are able to find a lot of solutions when you go bigger, right, Joel?
Here's what happens. You got to get started however you get started. You beg, borrow, and steal. You get your first money to get started. You're doing some deals. You're buying some notes. You're buying some real estate. Whatever you're buying, you're doing it however you can do it. But what ends up happening is after you've done 2, 3, 5, 10 transactions, you kind of wake up in the morning and say, gee, I'm pretty good at this. I probably should not have to pay the hard money lenders, the private money lenders, the same rates that I'm paying now, because I'm not as much of a risk. At the beginning, you kind of get it that you're a big risk and they're taking a chance on you. But after a while, you're pretty good. And that's really kind of what you wake up thinking. And that's when guys come out and they find me and they say, Joel, how do the pros do this? How is it that professional people make their money? So, here's what happens. I mean, basically, let me share my screen.
You got your PowerPoint. Yeah, let's jump into that there. So everybody should grab your notes and make sure if you ask questions. Do you want me to, if the questions are relevant where you're at, step in and ask questions, or wait till the very end, Joel?
You know what? I'm okay with you asking questions. Okay. If you think it's a representative question, what I don't want is somebody to say, I got a property at 44 Cherry Lane. How do you do that? Because that's not fair to all the people who are listening. So let's try to keep them general. And if it's not a general question, I'm not going to answer it. We'll take it offline. You know what I mean?
Sounds good, Joel. So if you want to click on share your screen and pull up your PowerPoint, get rock and rolling.
So we good there?
Looks perfect. And I'm going to take away my video camera, so they're just watching you, but I'll be here in the background and jumping in and on.
All right. Yeah. So let me just work on this here. And I'm going to be looking between the camera and the thing here. So, just so you know. So this is really all about raising capital the Wall Street way. And understand it does not matter what you use the capital for. I'm not saying it doesn't ever matter, but for purposes of this discussion, whether you're buying notes, you're buying real estate, apartment buildings, building ground up, making a film, or doing venture capital, it doesn't make any difference. The technique is really the same. The way that Wall Street handles this. And what Wall Street is really, really good at doing that very few people know how to do is taking an asset like an apartment building, a pool of notes, whatever it is, and slicing it up like a loaf of bread so that people can buy exactly as much as they want of that asset. So they're going to buy some piece of whatever it is that you're selling. And that's really the trick to this whole deal. So let's talk about how we're going to move away from the expensive forms of financing and how you get to the next level. Because I'm going to tell you right now, I don't care how great your deal flow is. If you don't have the money to monetize that deal flow, you will never get to the next base, whatever that is for you. So you have to really be well aware of how important this is. So let's talk about the business of money, the money business, which is syndication. So you hear a lot about syndication. Syndication is nothing more than putting people's money together in a pool. Very simple. There's your way, the way you do it now, and there's the Wall Street way. And one of the things that, that is clear and obvious is that most of us, the way that we do it is we finance properties typically using either hard money, private money, JV money, whatever, however you're going to do it. There's a very small number of ways that are legitimate for you to do this business, for you to raise money and be compliant with both federal law, state law, and all. And I'm not an attorney, by the way, so let me just make that disclaimer here right now. I am a CPA, but I'm not your CPA, so I can't give you any specific advice. But the question that I always like to ask, and anybody who's financing properties this way, is you've got your way of doing it, but do you think that your way is a great way, or do you think maybe the Wall Street way is a little better? You think maybe those Wall Street guys know a little something that you don't know? And that really is a relevant question. So let's think about, who really understands this business better and who really is further along in this process. So clearly enough, Wall Street does not do it your way. Wall Street has a better way of doing it. It's more profitable, it's safer, it's less liability. All the problems that people have are much more under control of the way that Wall Street runs this business. So let's go from there. All right. Having a little trouble here with the mouse. Let's see. Oh, there you go. That's better. All right. So I got a friend. His name is Chuck. He and I were having lunch about a month ago, and Chuck is telling me that he's got this big development deal in escrow. He's got this big deal, and this isn't anything different than any of you guys. You get a big note deal in escrow. Somebody offers you a pool of notes, but you got to act fast, whatever it is. You just don't have the ability to close this by yourself. So he's got lots of investors that are circling the deal. They're all interested in the deal. None of these investors have closed. He doesn't know why. He's not a professional money raiser. I mean, as he tells it to me, I'm able to clearly hear all the reasons why people aren't closing. But the question for each of you is, who controls Chuck's deal? And when I asked Chuck this question, it was embarrassing and irritating at the same time. It bothered him greatly that I was insinuating that he didn't control his own deal. He goes, well, it's my deal. I'm the one that tied it up. I'm the one that got it organized. I'm the one that did everything. It's my deal. I said, well, the truth is, if it was your deal, it would be funded and closed by now. Because you don't have the ability to close, the investors and these people that you're begging to come into your deal are really in control. This is just not the right way to do it. So he's operating a higher level business with lower level financing, and it's a mismatch. And because of that mismatch, it's causing him all sorts of problems. So what's the solution? What kind of money does this guy need? Well, he needs money. There's a lot of different ways. He could get a bunch of his friends together and then go get a bank loan for the balance. That's okay. That's one way of doing it. But when you put friends together, then you've got all kinds of securities problems. Should he go to a private lender? Well, he could go to a private lender and have somebody loan him all the money, but then you're in the situation where the person wants to do due diligence and all the other things that are happening. Very difficult. And then hard money, of course, you have to have some equity money in front of the deal. So if you're going to buy a pool of notes, you have to be able to put some money in front of that debt that you're going to put on. And the hard money is just too expensive. And hard money probably doesn't apply for notes anyway, because they just don't get the security, the collateral, and kind of the backup that they need. So all these issues come into play, and it just doesn't really work. So to me, the solution seems so obvious, but to Chuck, it wasn't obvious at all. And maybe to those of you who are paying attention right now, the solution is not necessarily obvious. So here's what Wall Street does. Wall Street takes the pool, takes the building, takes whatever it is that you're working on, and slices it up. So in other words, let's say that it's $1 million deal and you need $1 million to close. Let's just say round numbers. You probably need to have some working capital. You probably need some rehab money. You probably need some extras. But let's just say round numbers, it's $1 million that you need. They'll slice it up into, let's say, 40 shares or 40 slices of 25,000 a piece. And then they'll go out and they'll offer them to people. This is what you would do. You'd say, hey, who wants to buy my shares? Somebody will say, I'd like to buy 2. Somebody will say, I'll buy 4. Somebody else will say, I'll buy 8. And you sell the shares until they're gone. And then now you have the money. Then you go shopping and you buy the share, you buy whatever the asset is that you want with the money, sometimes in hand in advance, sometimes done after the fact. But one way or the other, that's how you get the money organized. So you're not taking money from a professional hard money lender or professional private lender, from a bank. Now you can take the equity money that you raise and you can say, let's put up, instead of take that $1 million, let's put $500,000 into this deal and go borrow from a bank $500,000. Let me promise you that when you borrow $500,000 from a bank with $500,000 of equity in front of it, the bank is going to be a lot more receptive to lending you money than if you just ask them to put up money and you've put up 3, 5, 10%, maybe 0% or something else. So this is a much preferred way to do it. Now, how do you slice up a piece of real estate? This is the art form of Wall Street. And this is something that you probably have never been exposed to before. So let's expose you to this right now. First thing you do, this is very simple. You're going to form an LLC. Very simple. An attorney or you form an LLC. Then you're going to sell the shares, which can be crowdfunded or it can be done hand to hand, just meeting people. You're going to sell those shares to a bunch of people. Then first step in the deal is you're going to elect a president. The company is going to need a president in order to continue. Once that's done, the president is going to hire a real estate broker or someone else to represent them in the transaction. Now that could be a note transaction where you're buying notes. You might have to hire a broker or somebody who's licensed, or you can go direct, whatever you want. So then the asset gets acquired, the asset gets put into the LLC, and that's pretty much the way the deal works. So the investors come in, they put the money into the company then goes and buys the asset ends up in the LLC. And what do the investors have? They have shares of stock that they then own the LLC with. Say they don't own the asset directly, but they own the shares of stock, which owns the asset. And by doing it that way, it doesn't sound that different from, well, why don't we just get 10 people to just put the money and buy the notes? The reason it has to do with the way that the laws work. If you do it any way other than how we're talking about, you're going to probably find yourself in trouble and you'll have to talk to an attorney about why. But this is the way that professionals put these deals together, is you structure it in a way that lets people buy shares of stock in a company, and then the company goes and buys the real estate. So you get some protection and everything else. But lots of other great things happen too, and we'll talk about that. Why is it that you'd go to all the trouble to do this? I mean, why not just do it the shortcut way? Well, number one, you'd be out of legal compliance, and there are issues there. But there's a lot in it for the promoter. So let's talk about what kinds of things are in it for the promoter. The promoter is you. It's me. It's those of us that are putting these deals together. So the person that goes out, slices the deal up into slices of 25,000, sells them. That person is the promoter. They're the quarterback, sometimes called the sponsor or the deal maker or something else, or the manager of the company. And that person stands to benefit in lots of different ways. And this is what you have to understand. Number one is you have lots more control. The way you do it right now, you probably don't have a lot of control. So this is going to give you lots more control. It's also going to give you lots of speed, because if you have the money raised in advance, then you're going to find yourself in a situation where you can get what I always refer to as a readiness premium. If you show up and you say, listen, I'd like to buy this asset, and they say it's $1 million, and you say, well, all right, I'll give you $1 million. I'll be back in 6 months with the money. They're going to say, what, are you kidding me? I'm not waiting 6 months. Then I show up. I'm somebody that has a fund. I show up and I say, listen, I like the deal. I've got the money with me here today. I'll give you 800 grand on the spot. And the person says, 800 is a little bit low. How about 825? So I'll make 175,000 more just for being ready. And when you have to go shopping for your money, you're not ready. So now let's talk about this real quick. Um, this is not hard to do. I mean, there's a series of steps. You have to learn how this works, but it's not terribly hard to do. So, you have to be supervised and you have to understand what you're doing. You just have to have a little experience. This isn't going to work if it's your first day on the job, but if you've bought, 5 or 10 or 12 notes and you've turned them around, and you've revitalized them and you've done what you've done, then you're probably going to be okay. Here's another great thing is just because you have a pool doesn't mean you're exclusive to that pool. You can go do note deals in the fund, or you can do note deals outside of your fund. And that's another very good way of doing it. By the way, there are no interest payments made inside these LLC arrangements. So that doesn't mean the investors don't get paid, but they don't get paid interest. The problem with interest, when you put an interest note on a property or on a note or something else, what happens is that if you don't perform, then you breach the contract, because interest is a contract. And when you don't pay and you breach the contract, there are some rights that the other people have. And one of the things that they can do is they can foreclose and take that asset away from you. So even though you've put a lot of dollars into the asset, that asset then can be taken away and you can lose all the equity that you've accumulated, and all the economic benefits that have come your way could all be gone in a heartbeat. So you really want to be careful. So the way that I'm suggesting, there's no interest payments. Instead, it's what's called a preferred payment. The other thing is, if you structure these things correctly, your cost of capital is effectively zero because there's no interest payment. Now, that doesn't mean that there isn't a revenue share. So there is a cost, but it's not being paid before you get your split. So a lot of times guys will split their money. First, they'll pay the amount that's due to the note holders, whoever they are. Then they'll pay the interest payment, and whatever's left, they'll split. Well, so much money has been paid to the interest holder that the amount they split is very low. So if you do this right, you're going to pay for the rehabilitation of the asset, and then you're going to split. And that's going to give you a lot more than if you had to pay off of an interest component or something else. And that's part of what makes the benefit of working it this way, as opposed to with a hard money deal or a private money deal, so advantageous. Here's another one. This is probably the most substantial one. In addition to your participation, the readiness premium, and all the other great things that happen, you're going to get paid for your services along the way. So when you're buying the notes, there may need to be a note purchaser of record. Somebody's going to do due diligence on the front end. Somebody needs to be paid for that. And the investors, since they're not probably going to be paying you a salary, are probably going to be okay with you being paid to do the diligence on the front end, for you to do the acquisition on the front end, and then again on the back end, do the maintenance, do the collections. And every single step that you provide, you can take a fee for doing that, provided that you have properly disclosed this. And that's what we help people to do with the attorneys. We help them get organized. Number one, you have to learn how it works. And number two is then we help you put this together. So it's a compliant deal. And let me just say, by the way, that I didn't make this system up. As a youngster, I worked at Price Waterhouse, the giant accounting firm. And beside working on the Academy Awards, which was obviously quite a famous engagement, I did hundreds and hundreds of tax partnerships for real estate syndicators back in the 1980s. So I watched this business. I learned this business. This business is about 50 years old, and it's evolved just a little bit, but more or less, we're doing what is standardly approved of. It's understood by attorneys and accountants when they go to law school or business school. They learn how this works. The government of the United States has approved this. The Supreme Court of the United States has ruled on it. The IRS doesn't like it too much, but they don't have any choice, because the Supreme Court said that the tax benefits and everything else, they've laid it out in a way that the government can't really push back. So when it comes to this octopus, you're really being paid in many different ways, but they fall into two giant buckets. The first bucket is that you're being paid for being smart. Now, you're already being paid for being smart. Every one of you, that's what you do. You get paid for being smart. So what does that mean? Well, you find a note, you add value to it, you foreclose, you repossess the real estate, you sell the real estate, whatever it is that you do, you're being paid for being smart. And that's terrific. But in the course of being smart, you're spending a lot of time. So you also need to be paid for your time. And that's the second part of the formula. So all the fees that come are really based on your time. So when you get your big payment on the back end, that all goes straight to the bottom line. The way that a lot of guys run their affairs, the way that I see, is that they'll put some money out. They'll work for several months to, negotiate these arrangements and get everything all figured out. And then they sell the note and make a profit. They share the profit with those investors. But by the time they get it, they're so busy paying off all the credit card balances that they've accumulated during the course of their rehabilitation phase that there's no profit. That is not a wealth accumulation strategy. So the way that Wall Street does it is we get paid for our time, and then we get paid for being smart. You have to get both those things. And if you forget to get paid for your time, then the amount you get paid for being smart is just barely going to cover the time that you paid. So if you can work that out, it's going to be to your great advantage. All right. So what are things that are paid for your time? Number one, anything that you would pay to a third party, if you're capable of doing yourself, you're welcome to do that yourself. That could be anything, as long as you properly disclose. You're going to be paid for stabilizing cash flow and funding growth, all those things. And our workbook has a substantial list of these. Most of these are real estate fees, but we have a whole other page that's for notes. So there are real estate fees, there are note fees, and then, by the way, real estate, the note business turns into real estate, because after you foreclosed on a note, then you can start taking all the real estate fees. So you end up doubling up on those. So there's a substantial amount of fees that are handled. For being smart, you're participating in cash flow. You get back end profits and all the other money, and that's a cool thing. And by the way, I just put this out there in case this comes up. You want to make sure and take your share profit before the cost of capital. If you take it after the cost of capital, if you subtract your interest payments, the amount that you're dividing is going to be very small. Before interest, the amount that you're dividing could be very large. So you want to make sure that you do this correctly. And this is what we help people to understand. And granted, we're moving really fast here because I only have a little bit of time to tell you a bunch of stuff, but take my word for it. If you really learn how this works and you understand it, this is really the magic of money. This is the magic of structure, and it's the magic of really making big money. It's the way that the Wall Street guys do this exact thing. So here's my goal for you. My goal is to get you out of the note business. It's to get you out of the real estate business. What business should you go in? You're sitting saying, well, gee, in fact, Scott's probably shaking his boots right now and saying, no, don't take him out of the note business.
I love what you're saying, Joel. You're not offending anybody here, man.
But you don't want to be in the note business. You want to be in the money business, because when you have the money, you can buy all the notes you want. So you want to be in the note business. The money is not made in the real estate. It's not made in the notes. You know where the money's made? It's made in the money. And that's really the trick. It's not made in the real estate. It's made in the money. Because when you control the money, you can buy all the real estate, all the notes, all the assets that you want. And that is really the bottom line. So I've got a wholesale strategy example. This is really geared for real estate people, and not so much for you. But let me just run through this here real quick. Scott, you think this is appropriate to go through a wholesale example for real estate?
Yeah, I think it is. I think it's totally perfect.
I think people will get this right away.
Yep.
So let's say, for example, that somebody puts a building under contract for $1.5 million. I don't know how often this happens that you're doing these really big deals, but I just picked a big one just because. So it probably doesn't happen all that often. So you buy it, you set it up for $1.5 million, and you're going to sell it. You're going to sell the paper, and you're going to make $100,000 pretty quick, which is just terrific. Doesn't happen too often, but you're going to do it. And you're going to net $100,000. That's it. Now, if I syndicate this instead, and by the way, the difference between syndication and fund, a syndication is a specific project. That'd be like buying one big note. A fund is putting a bunch of money in a pool and then buying stuff over time. So one is you buy the note, you buy it, you rehabilitate it, you foreclose on it, you capture it, whatever you're going to do, you execute the business plan, and then you wind down the partnership. You give everybody back their money plus their profits, and you're done. You wash your hands. A fund is an ongoing situation. So investors put their money in, you buy notes, fix them, sell them, keep the profit, put it back in the fund, share the profit, some part of it with the investors, but you keep the principal. So you're not raising money all the time. In the syndication model, you're raising money all the time. Here, you're not. So the money comes in different situations. I mean, listen, some people have a fund and then they still do some syndications. Some people start with syndication, they morph into a fund. So it really kind of depends. So here's how it works in a syndication. Very simple. You got a contract on a building for $1.5 million. You're going to take a brokerage fee of 3%, so 45,000. Probably going to take a mortgage fee of a couple points on 75%, so there's 22,000. Then you're going to take a property management override for several years because you're going to be paid a property management fee. So let's say you make a couple of points for maybe it's more. Maybe you don't take an override. Maybe you keep the whole thing because the building's in your backyard. You're going to get a rehab fee for managing the project, or a construction management fee or something, or you get a general contractor fee if you're licensed to do that. As long as you're licensed to do these different things, you're good to go. And then you just have to disclose those things to your investors. You're going to participate in cash flow as another 80 grand over a period of time. And then you're going to sell the building for an appreciated value because you've done a lot of value add work. Let's say you're going to sell it for 2.4 million. The net you're going to sell it for after brokerage. So you're going to make about $700,000, give or take. And these are round numbers. And it's just an example over a period of, say, 5 years, but probably not that far out of the ballpark. And your share of the net profit is $280,000. So when you add, plus you're going to get, of course, the brokerage fee on the back end for 72. So when you add all these things together, the total that you'll have made between the fees, which is the time, and the back end split, which is the fee you get for being paid for being smart, it's $539,000, which is just over 5 times what you would have made if you were flipping or wholesaling this deal. And you can do two or three of these a year, and you can do them year after year after year, because this is not an extraordinary deal. It's a pretty normal deal, but it would be a pretty extraordinary deal, for you to wholesale this property. And by the way, even if you bought it from the wholesaler and that person made 100 on, pretty quick notice, you're still making a very, very solid profit. So it's a solid way to do it. And you just got to build your pipeline. It's really the way that it works. The investors are going to get about 12% a year, and you're going to make a pretty big clump. And by the way, are they upset that you made a big clump? Well, they're making 12%, which is pretty awesome. So I would say that most investors are going to be pretty satisfied with what they get. And, although they could try to recalculate what you get was laid out in advance in your documents. And you said, hey, listen, if we perform and do what we're supposed to do, we're going to get paid handsomely. You do that, and that's the way it works. So I would tell you, stop working so hard and start working more smart. And that's just something that people in our business don't always do. And if I can help you to take better care of your family and be smarter, then that's a cool thing. So let's kind of burn through a little more material, and then we'll take some questions. Scott, any questions coming in so far?
We got a couple here, but we're good.
Okay.
Let's keep rocking and rolling.
All right. So just by way of disclaimer, I'm not an attorney. I'm a CPA, but not your CPA. I'm not giving any advice. I'm just giving information. Everything that you do that's specific to you, you have to run by your own advisors. So let's work on making this week better than next week, because that's really, kind of what it is. I want to make it different. We're going to divide this really into 2 sections. The money business, it says 3, but we're going to have to leave one off in the interest of time. The money business, which we just kind of went through, we just kind of introduced why syndication is such a powerful tool. And then finally, we're going to talk about why funds get the best deal. And when you understand this, it will be very clear to you. And then finally, about crowdfunding. We're not going to have time to talk about crowdfunding in this little period of time, but we talk about this at the symposium where we teach this material in great detail. I mean, this material is taught over a 3-day period of time so that you can really understand it and then go out and legitimately, legally, and properly raise money to do deals. And it'll really help to professionalize your business. So I was talking to a guy today looking at raising a fund for acquiring assets. And, one of the things that was most important to him is that the collateral. He's very professional. The collateral needs to be professional, the documents. And when investors look at properly drafted materials, they really recognize that there's a right way to do this, and that's what has to happen. So that's where we're at. So and then we'll leave a little time for some Q&A. So I'm not making this up. I spent plenty of time at the School of Hard Knocks. I came from Price Waterhouse originally, worked in syndication. I'm just going to burn through this kind of quick. Spent the next several years in the real estate syndication business, then fell into a venture capital transaction called Financial Facts, which I built, grew, and ended up selling to a Fortune 500 company. And then spent the next many years in venture capital. And so in 2008, I got a call from an executive at Marks and Millichap, the big real estate company, and the guy asked me to come out and do a program for them on how to raise money to buy real estate. That's the program that we're offering to you. That's the program that Scott wanted you to hear about. And as a result, I've been running our Bullseye Capital Fund for the last several years. So I asked the question, which is more important, capital or deal flow? And a lot of people will tell me deal flow. Now, of course, the people who tell me it's deal flow are people that only have deal flow. But the truth is, if you go to a RIA meeting or a meetup or any other kind of a real estate meeting, and you show up and you say, hey, look, I have the most smokingest hot deal. Who wants it? You know what's going to happen? Nothing. Nothing ever happens because nobody has any money. So they can't really make anything happen. But if I show up and I say, look, I got $1 million on my debit card and I got to spend this money in the next 10 days, you know what's going to happen? The meeting's going to stop. People are going to line up and they won't be able to continue the meeting because everybody will want to get a piece of that debit card. And that really is the truth. And that tells you everything that you need to know about the importance of money versus the deal. Granted, deals are important, but you know what people always say? Bring a great deal, the money will follow. The money does not follow. If you don't know how to do it, if you don't know how to get the money, if you don't know how to organize the money, if you aren't ready to take the money, and you got to be ready to take the money, then all sorts of things would be done differently. So I asked the simple question, are professional investors, and I'm a professional investor, and some of you are potentially professional investors if you're not already, are they 500 times smarter than everyone else? And the answer is certainly they're not. But why is it that professional investors make more money in 5 days than other people make in 5 years? Why? I mean, why is that? Well, there is a reason, and I'm going to tell you what it is. And you are either going to get yourself onto my side of the table, or you're going to stay where you are on your side of the table. And that is entirely up to you. But I'll tell you, here's how this works. We understand, professional investors understand deal structure and the advantages that deal structure brings. What does that mean? What that means is that all the way that we structured that revenue octopus and the way that the deal, the money shows, where we have getting paid for being smart, getting paid for time, those are all structural components that make the deal work better than how you're working your deals now. Professional investors understand their marketplace better than other people. I would imagine most of you understand your marketplace very well, but if you don't couple it with these other things, it's not going to go your way. Finally, professional investors are highly focused. They don't jump around between asset classes. Like they're not working on funding films one day, venture capital another day, real estate another day, mortgage notes another day. They pretty much pick a genre and they target that and they get really, really good at it. And that's really important to do. And finally, maybe most important, they're always ready to go. And that's the question you have to ask yourself. Are you ready to go? My sense is that most people are not ready. And being ready doesn't mean, well, I have my private money lender's phone number in my Rolodex, my phone ready to hit the button. So when a deal comes along, I call that person. Because let me just promise you, remember that when somebody else loans you their money, they're in control of your deal. And that person could say, you know, I'm sorry, I'm on vacation with my family. I just got all tied up with another deal. I'm in a bad mood today. It doesn't matter what the reason is. But if you don't control the money, you don't control anything. So let's get you in control so you can have that readiness. And then maybe there's something else. And let me just tell you that there is something else. And that something else is that when it comes to money, everything is rigged. Everything, absolutely everything in this world is rigged when it comes to money. And I think that most of you probably believe that that's true. And it is absolutely true. You may not know what the rig is or where the rig is, but there certainly is a rig. And the bottom line here, he who writes the rules rigs the rules, and you have to get in the habit of writing the rules so you can rig them in your favor. And if you don't do that, you're either going to rig them in your favor or somebody else is going to rig them into their favor. One way or another, you either are proactive about this or you're going down the drain. That's just the way that it works. So how does it work in real estate and the note business? This example is really for real estate more so than notes, although probably 70% of the funds that we've built have been real estate funds, 30% have been notes. Most of the groups that I address are real estate groups, and there's so much crossover between the two. You guys all understand what we're doing. So let me just tell you, when it comes to money, everything's rigged. And let me tell you what the rig is in real estate. And you guys will understand this. Now, understand that a rig does not mean anything is illegal or improper or bad. It's none of those things. What a rig is that somebody bends the rules or writes the rules in their favor. There's nothing wrong with doing that. They just understand the game better than other people, and that's what it is. So let's take a look at how this works, and let's get a sense about it. By the way, let me just start by saying that in Las Vegas, we all know that the rules are rigged. We all know that the casino, everything is in their advantage. But because we all know that everything is written in their advantage, we don't even bother to ask the question. We just know that roulette, the odds are not favorable to us. Craps are not favorable. Blackjack, none of the games are favorable to us. They're favorable to the casinos. And by the way, all you have to do is look at the landscape, because you know that those casinos were not built by winners. I mean, if you need any other proof, I don't know what it would be. So here's the rig in real estate. Number one, my gun is always loaded. I am always ready to buy. I've got a debit card with money on it. I've got money in a bank account ready to wire at a moment's notice. So I am always ready. That's the first most important thing. Now let's keep going. All right. So let's say that a broker gets a phone call from his client, and the broker's client says, listen, I'm in a world of hurt. My business partner's cheating me. My wife is leaving me. The government's chasing me. I've got so many problems. I don't know what to do, but all I know is I got this property on 4th and Main. It's free and clear. It's worth $1 million, but I will take 600,000 right now, because the government's going to put a lien on it in 2 weeks. So I got to have the money in 10 days, or else they're going to lien my property and I won't be able to get any cash. So I ask you, would the broker call you? Now, I have said this to people in real life, and people will tell me that that is the snottiest question that, somebody said to me, you hedge fund guys are so snotty, you think your money is more green. And I will actually say our money is more green. And the reason it's more green is because we're ready. And I'm going to give you all the reasons why the real estate broker is going to call me, the guy that has the fund with the money ready to go, than calling somebody else, Dr. Smith or somebody else, because that person is not really ready to go. So number one, who's given deals to that real estate broker all year long? Well, I am. I'm giving deals to that guy all year long. So when that person has an opportunity to, reciprocate, that person certainly wants to do that. And then the next thing is, Dr. Smith, is this cash ready? Well, we don't know if it's ready, but let's say that the guy's got a couple $100,000 at Merrill Lynch or Bank of America, and it's in securities. Well, is the cash ready? No, not exactly ready. It's not exactly ready. He's got to sell some securities. Most people do not have the level of readiness that a professionally organized fund or group like us would organize, people that are organizing money the way that we are. And that's a big advantage that we have. Another important thing is due diligence. Let's say the real estate broker calls a meeting and says, there's a due diligence appointment on Thursday at 2:00. Oh, Thursday? I'm in surgery that day. I can't do Thursday. What other day could you do? That doesn't work. I can have 5 guys in any city in America any day that I want. And that's what needs to happen here too. So that's a reason that the real estate broker would much favor someone like me than a doctor. My schedule is clear. I can work on this nonstop. This is the most important thing that I have going on in my life. And that's it, because it's my business. The next thing is, I don't have to borrow any money. I've got the cash on hand ready to go. Now I may refinance it later, but that's not this guy's problem. I may pull my cash back out. Dr. Smith, if he's got a couple $100,000 in Merrill Lynch and the deal is 600,000, then Dr. Smith's going to need to borrow 400,000. And so you say, where are you going to get the money from? Well, I'll get it from Merrill Lynch. It's going to be like a line of credit. Well, that's great, but they're not going to give you a line of credit in 2 weeks or 10 days. They're going to need to do some examination. These things, it's inexpensive money, but it's slow money. And it doesn't give you that readiness premium that we were talking about. Another thing is the real estate broker knows from our experience together that I'm going to respect the commission because we have a lot of history. He doesn't know if Dr. Smith is going to treat him with the same courtesy. Another important thing, another part of the rig is that the real estate broker knows that we're in the same network. We go to belong to the same club. Maybe we network together. We dinner at the same restaurants, whatever it is. That broker, we have something in common. We're kind of near each other a little bit. So there's kind of a little bit of simpatico that we have together. And finally, there's a little bit of horse trading. And this is just a common thing, nothing wrong with this. But the way things work is, hey, listen, I'll scratch your back if you'll scratch mine. The real estate broker says, hey, Joel, listen, now I'm going to give you this really good deal. Would you mind to organize a dinner meeting for me and that friend of yours that you have, that private equity friend that I know needs to buy more real estate like you do? Sure, I'll set that up. So let's make that happen. So anyway, here's all the reasons that the real estate broker is going to call me. They're probably not going to call Dr. Smith, and I'm going to get the deal. Now, here's what ends up happening. When that's done, we buy this property for 60 cents on the dollar. And that property is worth at least 90 cents if you're going to sell it, super fast. So I'll sell the property to Dr. Smith for 90 cents. Dr. Smith thinks that he got a smoking hot deal, and I'll have made more money in 5 days than Dr. Smith will make in 5 years. And that's really the unfortunate way that the game works. And there's not a lot that you can do about it. Now, what I would tell Dr. Smith is, listen, instead of fighting, because you can't beat me because I've got the cash ready to go, is give that capital to me and let's go out and be a team. And that way I can find the deals because I'm on the street and my team knows what's going on, and you be the capital supplier and we'll split the profits in some formula. And that's really why investors get involved in these deals, because they know they can't beat us. So they want to participate with us to make sure that they get the best deal. And you try to get the best deal you can, but we'll beat you out too. And that's why I'm telling you that we want you to be ready. We want you to be able to go out and do better. So let me just make a suggestion. We produce a giant library of materials that we produce every week. Twice a week, we set out videos where people write in, they ask me questions. Joel, what's the difference between a syndication and a fund? What's the right rate of interest to pay? What's the preferred? How does this work? How does that work? And we answer these questions. We've got a giant library with 140 assets in it, and we answer these questions. You're welcome to have those. They're absolutely free. Like Scott's thing, text the word asset to the number 72,000, and you'll get free information. You'll get this. We're not going to spam you and stuff. You're going to get the videos, but there's not a lot of garbage that goes out to our list. So we have a very simple arrangement. Go ahead and text the word asset to the number 72,000. I would do that right now while we're on the phone here together, and you'll start getting those videos. And once you open up the videos, the whole library opens up to you, and you can have lots of videos, not just the one that was received in the mail. And people binge watch these. I mean, they really do. So this is it's a cool thing. So people ask me, Joel, where are the investors? In the old model, years ago, you have to go to the country club, and they were hard to find. But now with the crowdfunding rules, it's gotten a lot easier. You can advertise for investors. There's a lot of ways to find investors that are really powerful. We don't have a lot of time to go into this right now, but in the old rules, private placements were private, and now they're not. So investors are sort of like yellow cars. If I tell you to look for a yellow car, you're going to find them. But right now, you're not finding yellow cars because you don't know what to look for. You're probably finding a lot of hard money lenders, a lot of private lenders. Why are you finding those people? Because that's what you're looking for. So if you start understanding what the parameters of a person is that would make a private investment as opposed to a private money loan, which by the way is not secured. Remember, they're buying stock, and then you get to use that stock, that capital from the sale of the stock to buy assets. You just have lots of flexibility, and then people are sharing profits. So if you understand the profile of this kind of person, then you'll have a much easier time of doing that. There's my friend with a yellow car. So, listen, if you're ready, they tell you that when the student is ready, the teacher appears. Some of you are going to be ready. And if that happens, I'm happy to be your teacher. I'd like to help you to get through this. Are you somebody that can control the money? Well, it depends. If you're a real estate professional, licensed in some state, then you're eligible. That could also be a mortgage broker, somebody who's handling notes and otherwise. So if you're licensed to do something in real estate, then you're eligible. You got to meet one of these criteria. Alternatively, you could be a financial or intermediary type person. If you meet that criteria, you're eligible to participate with us. And finally, if you're an asset class specialist, like you really understand notes, you've done 5, 10, or 15 deals or more, then you're eligible. And the reason we have these criteria is because we don't want beginners, we don't want wannabes, we don't want early stage people, because this is a pretty good trick, and a beginner would not be able to pull it off. So, but for people who are ready, it's an amazing, powerful tool that you can't really imagine. If you're ready to go, April the 19th to the 22nd, we're doing our 24th National Symposium. We have produced more than 1,000 people have gone through our program. We've probably produced close to 100 funds and more than probably getting close to 200 syndications. So it's been a pretty substantial run. This program will be in Las Vegas, and we're only selling 50 seats. That's it. So Scott, we put a couple of aside for your people. And I will say that, the seats, by the way, they're $2,100 a piece. For this evening, we'll set them at 2 for 1. So we're not going to reduce the price, but if 2 people from the same company want to come and they want to do it, they buy their ticket and send me their paperwork, and I'll send them a link to register the second person for free. So,
nice.
Scott, that's pretty much, that's what I want to tell your guys. I mean, I don't know what else they need to know, but there's the info. If they want to buy the ticket, they can go on Deal Making Symposium. We just asked them to text the word asset to 72,000.
Yep.
I mean, this isn't something where anybody's going to twist your arm. It's something that you either get what this is or not.
That's the biggest thing there. There's no gimmicks with this, and that's one of the beautiful things that we had you on for, because you've done such a great job helping put some big funds together, some syndications. I got a question here. What would you say the average size of the syndications that you see are taking place out there? What's kind of the average dollar?
Almost all of them for people who are kind of early stage are between $1 and $10 million.
Okay.
I mean, you can make a lot of dough on $1 to $10 million, though. You can make a lot more than you're making now.
Yeah, and it's also easier. And it's once you get the word out and know what you're doing, raising $1 million is a lot easier than most people think, huh, Joel?
Well, it's I won't kid anybody. It's not laying in an envelope in the street, right. But it gets easier over time. And then once you have a couple million, then you can go to 5 million. Then once you have 5, you can go to 10, because you're accomplishing something. You're doing good with the money. So, that's just the way it works.
Right. So the 19th to the 22nd, that's a Sunday through
Sunday, right? Sunday night through Wednesday.
Right. And where's it being held at in Las Vegas at?
We only tell the attendees.
Okay, no problem. That's good.
It's one of the good hotels, and I get it,
because you're keeping it secret. I understand that you don't want people just showing up.
I'll tell you why. We don't hire security, and so we don't want any sneakers. I mean, we've had a couple of occasions where a couple of people found out they tried to sneak in, and it's very awkward. So I just prefer to share the information. You come, and no sneakers.
No, good question. That's a good response. I can understand that. John asked the question here. I guess it's a little early on. Says, do I have to find the real estate first in order to have the fund slice up the shares?
Okay, so if you are doing a syndication project, you probably have to find the deal first. And then you have to go out and get the money, get your documents organized. That is really clumsy. It's a really hard way to do it. But that's the way a lot of guys do, and sometimes it works out. Listen, we build syndications, we build funds. Sometimes there's a reason to do it one way or another. The fund, you generally go get the money in advance. Now, it's a little harder to get the money in advance because people have to trust you more. So, if you have more deal flow, then, having the money in advance is awesome. If you don't have a lot of deal flow, then you probably, do not want to have the money in advance. You probably want to look for the money as you find deals. So it really kind of depends on your situation, but you can do it either way. And the beauty of this business, it is so flexible. It's a really flexible business. And as long as you know what you're doing, you're good at your craft, this business is going to work out well for you.
Got a question from the online live stream on Facebook. How difficult is it to get your syndications approved by the SEC in the different states?
You do not have to get them approved. We work under these rules that make us exempt.
Nice.
So there is no registration. And that's part of what we teach you in the class, is the way that you stay exempt. I mean, listen, when you were 15 years old, you learned how to drive. It seemed like so complicated. You took a class, you practiced, you took a test. There's no test or anything here, but you're going to take a class, you're going to learn how to do it. And then we're going to help you to kind of make it happen if you want that. And then ultimately, you'll be up and running. And by the time you're 17 years old, people are shaving in their cars and putting lipstick on while they're driving. I don't recommend that. I don't like that as an adult, but that's, you get comfortable. And once you get better at doing this, the same thing is going to happen for you.
Now, every different deal's a different entity. You're keeping everything separate, correct? You're not.
Well, if you're doing a fund, they can all go into one pool. If you're doing syndication projects, then everyone's going to be separate for sure.
Okay. Yeah, that makes sense.
You
And that's
can
a small
separate,
cost.
even in a fund, you can separate them for liability and asset protection. You have a lot of flexibility, but you don't have to.
What's been in your experience? It may not mean anything that shocks you. What's been the most interesting thing you've seen somebody put a syndication together for?
Well, cannabis is really big.
Okay.
Now, I mean, people are doing these cannabis deals. Listen, I've been involved in every kind of venture deal you could think of. I've been involved in film finance. We had a finishing fund where, guys would run out of money and then we'd buy their assets, turnaround funds. I mean, there's all kinds of things that you can do. And we've been involved in a lot of those different kinds of things. So I can't tell you what's the most interesting. I will tell you, when I was at Price Waterhouse as a youngster, beside doing real estate, I was doing windmills, those energy solar.
Oh yeah.
I was doing those kind of deals, So every one of them, they're all interesting. They're all interesting. And whatever you're doing, tell you what's interesting is making money.
Yeah,
you can make money in every one of these deals.
There we go. We like that. Got another question here. Let's see. The question is here. Yes, if you came on late, yes, it's recorded, so you can catch the entirety, John, there for that came on late there. It's recorded. We'll get that out to everybody first thing in the morning or two for you. But you do this once a year, or no? Yeah, this 24th time you've done this.
We do this. We have been doing it twice a year, but frankly, I'm retiring from my fund, and this is going to slow down. So there are not going to be all that many more of these.
There you go. Okay. Well, that leads to people need to take action here. Are you gonna retire when the Dodgers win the World Series finally?
God, wouldn't that be awesome? That'd be awesome. I was in Houston this last week, and there's quite a lot of animosity there. So I drove by Minute Maid Park, the place where the problem happened. So
I am an Astros fan.
I know.
I'm a bigger Twins fan than I am an Astros fan. But for
Scott, you probably know I was at the World Series Game 7 in 2017 when the Dodgers lost, and Darvish pitched that terrible first inning, and maybe it wasn't such bad pitching. Maybe it was that the Astros had the angle.
You never know. You never know, definitely. But that's the beauty with what you're doing here. It takes the mystery out of everything. Like you said, you've got everything up front. You're making more money by putting it all together, and you're an expert at doing this and helping. I know you've got a huge success rate. A very high percentage of the people that are coming through this are doing amazing things. And
we've got a lot of success stories. A lot.
Yeah, definitely. So here's the website, everybody. I put it in the chat roll. If you're on here live, you can click directly on that as well. Otherwise, for those that are watching the replay, you put it in the replay there for you. But it's dealmakingsymposium.com.
Yes.
If, like you said, or you can text the word asset to 72,000, or you can go to syndicatefast.com as well to get registered for the videos and stuff like that too. You've got a podcast too, right, Joel?
Yeah, it's called Profit from the Inside. it's not a real estate podcast. It's strategies to give your business the inside track. So it's really it's a business podcast.
Yeah, it's great stuff, really great stuff. But if you're really, can you imagine us coming into Vegas on a Sunday night and walking out Wednesday night, flying out of Vegas Wednesday night on McCarran, having a game plan for doing something big. I mean, we're all wanting to take our business to the next level. And one of the biggest regrets that I did, I'll tell you this right now, is I didn't take more time to do this. I got used to doing the old way of doing things like Joel talked about beforehand, thinking, just keep going. It ended up biting me in the butt. If I'd have done it exactly how Joel is outlining this for you guys, it would avoid a lot of headaches. And this is a great way. I wanted to bring him on so that you guys don't end up running the same mistakes. And that's one of the best things. Hey, learn from my mistakes. Learn from some of the things that we goofed up on and put things together the right way. That's why I've had Joel on. That's why we've had on the podcast before. I'm a big fan of what he is doing. We met, was it 7 years ago at like the first crowdfunding class or something like that back in Vegas?
Yeah, the crowdfunding class. Yeah.
Yeah, definitely. So Joel knows what he's talking about. Let's see here. We've got another question here from people. Say, that's great. John says, I was offered a portfolio of 90 notes from Fannie Mae. So I don't know what John's getting at there, unless is that what that'd be.
Well, so Scott, let me just tell you, here's how this works. Okay. Yeah. So I don't know how much a portfolio from Fannie Mae is. Let's say it's $10 million. Okay. Let's just say, I mean, that's a big number. That's a lot of notes. I mean, I don't know, what the deal is, but so let's say that there probably is some commercial financing available. Let's say you got to put 35% down, and Scott, you're the expert and you would help organize this, but in order to get financing, you got to put some equity in. So let's say you raise $3.5 million of equity from the investors, and you get, 35 guys to put in 100 grand a piece. Each one gets the slice is 100 grand, let's just say. And then everybody puts their money in, and you, the promoter, are going to control a large percentage of the profit, 20, 30, 40% of the profit for putting in a relatively small amount of the capital. And you're going to run the deal, you're going to get fees, and you're going to make it happen. And that's the way it works. And this is legal, this is compliant. The security attorneys organize all these things. It's a really good business. But the key word there is business. It's not a one and done. It's not a fly by the seat of your pants. You don't make it up as you go along. You got to do it right. Because if you don't do it right, you're going to find yourself in a world of hurt. So if you want to play ball at a bigger level, you got to learn how to play ball. You don't just show up and start throwing the ball around. I mean, you got to really learn how this works. This is not something that you do by trial and error. One of the things I'll tell you, investors do not want to find out that you're practicing with their money. There's a reason that doctors practice on cadavers. These are low value targets, and you want to make sure that you're not practicing with their money, that you're not playing games, that you're doing a good job. And as long as you do, this is going to be a great format for you. So, Scott, just to reiterate, give people through the end of the evening. If they buy their ticket, go to dealmakingsymposium.com, buy one, I'll give you a second one. Buy two, give you two more. And, that way you can share it with a friend, or, you can bring a colleague or whatever you want. That's the deal for here. These tickets never go on sale, ever.
Nope. And they shouldn't. They shouldn't. With what the value you're offering is 4 to 5, if not 10 times what the cost is.
I'll tell you the thing. If we were selling beginners, they would probably sell for 5 times more.
Yeah. Oh, yeah.
But, we're selling to sophisticated people. We're building a network of syndicators, of very sophisticated people. And that's the way it works. I mean, it's, we can debate the merit of that logic. But the way I look at it, these are sophisticated people. And sophisticated people, they get it. So,
yep.
And we have a lot of alumni that ask to come back, and we make a few seats available every time for alumni to come back, because the quality of the network that we deliver is quite extraordinary.
That's the truth. Totally the truth there. All right, guys, gals, seriously, this is the opportunity for you guys to really take things to the next level. I know many of you guys are closing on deals. Do some things. Go to dealmakingsymposium.com. Get your 2-for-1 tickets now. Very special offer that Joel offered up there. If you're not ready, then check out the syndicatefast.com. It's a great way to get videos and get ready to rock and roll for the next time that Joel offers this up. Get on.
And listen, and even after you buy your ticket, I mean, we have a membership library. As soon as you buy your ticket, that library opens up for you. and people can really, they can really learn a lot before they even get to the program.
Awesome. Well, Joel, thanks so much for coming on tonight. We'll let you get back to your evening. Thanks for coming and delivering as always.
Thank you very much.
Guys, take advantage of what he's offering. Dealmakingsymposium.com to get signed up today and get the 2-for-1 special. Otherwise, we look forward to seeing you in Vegas. All right, Joe?
Great. Scott, thanks very much.
Thanks, buddy. See you later.
Take care.
Bye. All right, guys.